Hello, welcome to the Off-Highway Global Briefing organised by Off-Highway Research. I'm Chris Slight, Managing Director of Off-Highway Research, and I'll be your host today. Thanks very much for joining us. We have over 800 people registered for this event, which we hope will give you the latest insights into the outlook for the global economy and how that relates to the construction equipment industry. Today's speakers will Yelena Shuletseva, Senior US Economist at Bloomberg Economics, myself, and Carl Gustav Göransson, former President of Construction at CNH Industrial. We'll have 3 presentations today with an opportunity for questions after each. And if you'd like to ask a question, please type it into the Q&A tab and we'll get to as many as the time allows. I would like to take this opportunity to thank our sponsors, Carlisle Brake and Friction and Faster, whose support have made this webinar possible. Thanks also to our media partners, International Construction, Diesel Progress and Diesel Progress International magazines. We also hope to make a report on key points from today's webinar available, and we'll be in contact following the event to pass on details for that. So without further ado, we'll begin with our first speaker. Yelena Shuletseva is a senior US economist for Bloomberg Economics, a research platform that provides context on industries, companies, and the global economy, available on Bloomberg Professional Services. She previously worked for 10 years as a US economist at BNP Paribas, and if she's familiar to you, it's because she often appears on business television and radio and is frequently quoted in print publications. Yelena holds a Chartered Financial Analyst designation, as well as master's degrees in finance and investments and economics. So we're absolutely delighted to have you with us today, Yelena, and please take it away.
Thank you so much. It's really a pleasure to be here, and I'm really looking forward to our presentation and also your questions. But before, let me just share my presentation with you first. And okay, great. So I would like just to say a couple of words as an introduction. So I think when we speak about economic growth and economic outlook going into the next year, we need to think about 3 main factors. And, they're just developing right in front of us right now. So first of all, it's the virus itself. So it has defined the trajectory of economic growth throughout this year, and it will be a major factor going into the next, of course. So as we speak, unfortunately, the number of cases is really accelerating, and it accelerating across the country, not only in urban areas and highly populated states, but it's also spreading into each and every region and economy, whether it's a large city or a small town in the United States. So that will slow economic growth in the 4th quarter and into the 1st quarter of next year, and things will really get worse before they get better. So in that respect, the second factor that will really define what happens to the economy going into 2021 is the vaccine. And it's not only, the news of a successful trials, which are obviously great news and very encouraging in a sense. It's also that we need to implement it on a widespread basis. So, and people need to accept the vaccine as safe, and they need to really get vaccinated. So that means we probably won't see a positive impact from a vaccine until later next year, probably until the 2nd half, really, in terms of the reopening of the economy and how this will, really mean a rebound in economic growth. So, and the third factor is politics. And in that sense, what really happens to the fiscal stimulus or the lack of thereof. And I would argue that the chances of a big fiscal stimulus, something like we received when the CARES Act was implemented back in the spring, they're really evaporating as we speak. So I think the outcome of the election really means that the new fiscal stimulus, if there is one, will be much smaller, probably in the vicinity of 500 billion to 750 billion max. And it will be really, really targeted towards certain groups, and perhaps not so much towards state and local governments, but rather towards unemployment benefits and things like that. So thinking about all these three things is really what we keep in mind when we forecast economic growth going into the next year, and when we think about policy and implications for the markets going forward. So let's talk a little bit about this in a little bit more detail. So I spoke about the election outcome, and at this point, obviously the most likely scenario is the Democratic president and a divided Congress going into 2021. Although there's still a distant possibility of Democratic sweep, which may happen if the two runoff Senate elections result in the Democrats taking 2 seats and the vice president breaking the tie in terms of what needs to be done to pass through major legislation. So, but at this point, the most likely scenario again is the Democratic president and a divided Congress, which means significant gridlock and inability to pass any major legislation going forward, well, at least in the next couple of years. So what it means is that small fiscal package, probably delayed well into the first quarter of next year. And that means slow economic growth relative to other scenarios. Our baseline is for economic growth to rebound by 3.5% in 2021 from what we expect to be a 2.9% decline this year. And that will only slowly bring the level of economic activity back to pre-crisis levels, probably by the end of next year. So what keeps this economy going, and what we will need to keep the economy going into the next year? So before the crisis, the key driver of economic growth was the US consumer. And I don't think there is any reason to believe that it should change during the crisis or during the time of the recovery. So personal consumption is the biggest part of economic growth in this country, and it will remain so. But there has been a huge change in how we spend. So since the pandemic really started, we saw a significant drop in consumer spending in the spring months, and then it recovered significantly since then. So a lot of people talk about retail sales, for example, and we received another reading this morning, and we saw another increase in retail sales. But that is actually showing you how much goods spending has recovered. So this chart shows 2 lines. The yellow one is spending on consumer goods. The white line is spending on consumer services. And you can see how much bifurcation we have between the two. So goods spending has recovered significantly above the pre-crisis trend, I would argue. And that, this is all your durable goods spending. Things like, household items. You really spend a lot on improving your houses during the pandemic so that you can work better, more efficiently from your home offices. We also bought a lot of cars, and it's not only the pent-up demand that we saw when people wanted to buy cars, but they were not available during the spring months, but it is also demand on top of that, coming from people who are not willing to travel by public transportation anymore and need an extra car in the household to get to work more safely. So we will see that continuing into the next year as well as the economy recovers. But this is all great news. But the part of the bad news is that beneath the surface, beneath the headlines of continued increases in payrolls and sharp declines in the unemployment rates that we observed over the last several months, duration of unemployment is really surging. So for people who are still unemployed, they continue to be so, and they will probably continue to remain unemployed going into 2021, just simply because those jobs are not available. And a lot of these people used to work in the service sector, and the services are still closed. The restaurants are going to close again, probably. Well, at least they will not reopen to the same extent as before the pandemic. And we don't travel as much as we used to. So this will probably stay with us going into the next year, and well until after the vaccine really fixes the issue. So a lot of job losses become permanent. So in October, we actually reached quite a grim milestone, I would say, in terms of job losses. So in October, permanent job losses for the first time exceeded the number of temporary job losses. So people thought of them losing their jobs in the beginning of the crisis as something that will be transitory. And as we waited longer and longer, and the virus stayed with us, or those job losses became permanent as companies closed, went out of business, and we will probably continue to see more of that going into the next year. So I would also like to show this chart, which is quite a terrifying one. And that shows a number of cases that are rising across all different regions of the country. So back in March and April, the pandemic was really hammering the northeast of the country, cities such as New York and other highly populated areas. And this is the blue line on the chart. But as you can see, right now, it's very much widespread. It's really a really bad situation in the Midwest of the country, more rural areas, not only urban centers, and it's pretty much everywhere. So that will certainly affect economic growth in the near term, in the next few months as we enter the new year. So with that, I would like to probably wrap it up for now. I'll be happy to address more topics, such as what the central bank will do, what our views on expectations for interest rates and other aspects of economic outlook in 2021 in the Q&A. So let me just stop there and turn it back over to you.
That's great, Elena. Thank you very much for that. I think what you've said there about the US economy is something that we can see in many other parts of the world. So it's a great scene setter. One of the questions that we've had on the channel is asking you to unpack that statement you made that a democratic sweep would lead to the highest economic growth. There's obviously a school of thought that when the Democrats get in, they just put some more taxes on top of the taxes. So could you just explain the logic behind that a little bit?
Sure. So we looked at several different scenarios prior to the election, and democratic sweep was one of them. So I'm not here to tell you what is good or bad. I'm just here to tell you basically what the expectations are and those expectations for the near-term economic growth. So obviously, increasing fiscal deficit is not a great thing in the long run. By the time I retire, I'm probably not going to have much in my Social Security account. But right now, at this point, I think, first of all, the CARES Act, the legislation that was implemented in the beginning of the crisis, the CARES Act, was a great response. So that really helped economic growth to recover in the third quarter of this year, and the savings from all the stimulus checks and unemployment benefits are still providing a cushion for consumer spending right now as we speak, and probably will help a little bit going into the next year. So when we looked at those scenarios, different scenarios, such as a Democratic sweep versus a Democratic president and a divided Congress, we thought about it in terms of the possible fiscal package. So in our baseline, we thought, okay, maybe we will see something like a $1 trillion package in the first quarter. The divided Congress means much less than that. So we will certainly see the Republican Senate opposed to any spending, save on state and local governments. If there is a distant case because of what happens in Georgia, that the 2 seats in the state of Georgia go to the Democrats, and then the vice president breaks the tie. In this case, the Democrats can implement a fiscal package in the vicinity of $2 trillion or more. And they can do it if they have both the presidential ticket and Congress. They have not been able to do that since 2010, I believe. So in this case, short-term growth will certainly benefit because people will probably get more stimulus checks, and those with very high propensity to consume, those in the lower income bracket, will spend this money. And again, this will boost consumer spending, and in turn, it could boost economic growth to a degree of probably something like 5% fourth quarter over fourth quarter, as compared to our baseline case of 3.5%.
That's great. Thank you very much, Elena. One other quick question. Most of the people on this webinar have some connection to the construction equipment world. So I just wondered if there was anything you'd seen in terms of policy announcements or expected stimulus spending that would be particularly good for construction, either public spending on infrastructure or anything that's going to boost private wealth and get people improving their houses or buying bigger houses.
Again, on the fiscal front, I don't think I have really much good news here. I think what we are really facing in the next couple of years is a significant gridlock. Watching the president-elect speaking yesterday at a press conference, on his economic plan, I did not hear any concrete suggestions. That it was just, again, another political talk rather than just significant economic plan. So I think both sides of the aisle, whether it's Republicans or Democrats, seem to agree that infrastructure is something they can, certainly be in favor of. But even then, you don't really see a significant action on that front. And I think what we will witness going forward will be just a lot of political bickering and a lot of disagreement, just to pass even a simple legislation. In terms of the Fed, though, I think that we will continue to see very low interest rates. So we don't expect, which would be very supportive for the housing industry and construction industry overall. We don't see a rate hike until at least 2025. And it's really our expectations because of what happened recently in terms of the change in the policy framework. So the Fed is not going to raise rates until they see sustainable pickup in inflation above 2%. So we don't see that happening until the output gap closes, and that is probably not going to happen until sometime in 2024. So we will see some pickup in inflation just simply because of the base effect in going into the spring. So inflation was very low in the spring of 2020. So compared to that, inflation will be much higher in the spring of 2021. But that is not what the Fed wants to see to start raising rates. They really want to see economic growth, diminishing slack, resulting in labor inflation, and that in turn filtering into a broader inflation pickup. That is probably not happening until a while into the recovery. The Fed is very well aware of what happened back in 2013. They learned their lesson from the taper tantrum back in 2013. They learned their lesson from premature tightening of economic conditions, of financial conditions back in 2015, when the economy was still quite on a weak footing. So a lot of them said we would not have hiked rates under the new policy framework. So at least we will have low interest rates for as far as the eye can see.
That's great. Thank you very much for your input there, Yelena. I believe you're staying with us until the end of the webinar. So if there are a couple more questions, we'll hope to circle back around to them. So with the scene set, I'm now going to take a closer look at the situation for the global construction equipment market. Having joined this webinar, I'm sure you're familiar with Off-Highway Research to some extent. We're a market research company specializing in the analysis and forecasting of international construction equipment markets. We've been doing it for almost 40 years, and I've been with the business for 5 years. And before that, plenty of experience of the construction equipment sector going back to the mid-1990s as a journalist and a magazine editor in the industry. So with that, I'll get over to my presentation and we'll get started. There we go. So global construction equipment markets. A quick word about the global market. It's cyclical, of course, and the recent history up until this year has been pretty good. There was strong synchronized growth for about a 3-year period, 3 to 4 years, that took us to a very strong peak in 2018 and 2019. Record volumes of about 1.1 million units of equipment sold in each of those 2 years, with a value of about 110 billion US dollars. So that was clearly the peak, and really the world was expecting the market to start turning down in 2020. And what we've seen, of course, is that 19 has taken what was expected to be a soft landing and made it considerably harder. So let's have a look at that. What we see here on the red line is the historic unit sales of construction equipment. And over on the right of the panel, you see our previous forecast, the pre-COVID-19 forecast of a fairly soft landing, and our revised forecast now. So compared to a 5% decline in 2020, we're now looking at 13%. Now, you could be forgiven for looking at that and thinking, well, okay, the 13% down is worse than 5% down, but, you know, come on, what are we complaining about here? The volumes still look pretty big. They look like there are much steeper downturns in history. You know, what's all the upset about? Well, I think the point here is that we need to dig into the components of this global growth. And the real key to this is China. What's happening in China this year is that whereas previously the market we felt had peaked last year and we were expecting a decline, in fact, we felt, you know, this time last year, the decline was probably long overdue. When China came out of lockdown in March, April, it instituted a very, very strong stimulus program. And rather than that decline, we're seeing the market climb 14% this year. In fact, I would say at least 14%. So if you look across, that's the third highest volume on record for the Chinese market. Not as high as the stimulus boom we saw in 2010 and 2011. But if you look at the way the market crashed after that, you know, probably a good thing. But nonetheless, you know, very, very high historical volume. We're looking at about 350,000 machines. So in the context of a global market, which this year will be about 950,000 machines, China is by far the largest market in the world. And obviously it has a major global impact. So if you then look at the world excluding China, you see a very different picture. Previously, as I said, we were expecting a fairly soft landing. Our revised forecast now is for about a 22% decline. And you can see in the context of history, that is a sharp downturn. That's a very tough thing for the industry to absorb in just 1 year. Almost every market in the world, apart from China, will see a decline this year. And a mild decline would be of the order of 5, 10, 15%. As you see there, 22% is the average. And there will be a couple of economies that see a much steeper decline, maybe as much as 30 or 35%. So that's what the impact is for pretty much most of the world. We do expect 2020 to be the worst of it and a fairly V-shaped recovery, but the upturn will be shallower than the downturn. And so we're going to take a couple of years to get back to where we were, to some healthy volumes. Just to kind of come in a little bit closer, what I've compiled here is the quarterly financial results from the 19 or 20 international OEMs. So this does exclude the Chinese manufacturers. This is the Caterpillar, Volvo, John Deere, not John Deere, Hitachi, Komatsu type companies. And so I just wanted to use this to unpick a little bit of what's been going on. You can see here in the fourth quarter, normally you would expect the fourth quarter to maybe tick up a little bit, but we did see from the third quarter, which is always the weakest, sort of a flat performance. So that did indicate that the cyclical downturn had set in even before COVID had really sort of been felt, and certainly not been felt outside China. Then in the first quarter, as the pandemic spread internationally, revenues came down, and then of course down again in the second quarter. So what we've seen in the third quarter is the faintest of upticks. Now, you might be forgiven for thinking, oh, look, Chris, you're just clutching at straws. That's barely measurable. But if you look at what happens most of the time from second to third quarter, the third quarter is normally the weakest one in terms of revenues in any given years because of the seasonality of this industry. And profitability is certainly very rarely much better than the second quarter unless you're in a very, very strong upturn. So it does kind of illustrate, I think, that we've probably turned a corner from what was a cyclical downturn and then the COVID downturn. And the other point I'd make is that the revenues for this industry haven't fallen through the floor. We're still in a reasonable range, and in fact revenues haven't really dropped as low as they were in the previous trough of the cycle of around 2015, 2016. So it is, you maybe have to be an optimist to see it, but I would say quite clearly that there has been an uptick, and hopefully a corner has been turned in the third quarter. So where are we now? As I said, there are clear positives, both in revenues and profitability. Profitability is one to watch, though, because it does depend what the fourth quarter brings. That's normally not the best for margins in this industry. But we also face the situation that lockdowns are tightening in many countries. Having said that, construction is relatively unaffected. And in researching this, I was very fortunate to find from one of our partner magazines quite a detailed article explaining that a lot of the lockdowns in Europe in particular aren't really including construction. You can understand why. You're able to socially distance on construction sites. They're often quite big, and it's an environment where you can wear the right personal protective equipment. And of course, whatever the health concerns are, the reality is that governments really want economic activity to continue. So they're looking to industries like construction to keep ticking over, to keep the economy turning. But there will clearly be a downturn. So I think for the last couple of minutes of my presentation, I just want to kind of look at that a little bit, look at what we're expecting, and maybe what we would hope for and what would be good for the industry. So what do we need? I think the top of the list is very clearly government infrastructure investment. There's obviously a very, very strong job creation aspect to stimulus spending. And I think governments do tend to appreciate the point these days that for every pound or euro or dollar that you spend on construction, you have a 3 to 4 times multiplier effect on the wider economy for what it does for supply chains. That's very, very important for this industry. For the mid and large sized equipment, the area where there really is value, it really is infrastructure which drives things forward. I think, you know, we really do have to hope to see continued job protection and support for viable businesses. And the reason that's important in this industry is, as Yelena alluded to, you know, the residential sector is really all about private wealth. It's about whether people can afford to buy a new home, and therefore that stimulates building or even improving their existing home. And that's very, very important for particularly residential new build, for the volume machines in this industry. You know, depending where you are in the world, it varies, but anything under about 10 tons is going to have a big foot in the residential world. I think if I have a concern, it's for non-residential construction. Clearly, I imagine many of the people watching this webinar are kind of sitting in their spare room in shorts and t-shirts, and that's the way many office workers have gone this year. With companies in cost-cutting mode again, I think it does spell a very, very difficult time for non-residential building. Companies are saying, look, why do we need an expensive city centre office? So that's obviously going to be a brake on the building of city centre office space. Add to that the issue that a lot of the worst affected industries and the sections of economy do have quite a big foot in non-residential building. If you think of things like hotels, bars, restaurants, bricks and mortar retail, travel, you know, they're all of themselves quite important. Companies are going to say to their employees, yeah, look, you've got through the last 6-8 months doing video conferences. Do you really need to jump on that plane and stay in that hotel? So I can see the whole economic environment around this area being quite challenging for some time to come. Just one final word on stimulus. If you look at, you know, the recent history of this industry and back to this curve of the ups and downs of annual sales, it's very interesting to look at what effect stimulus has. Obviously, these were boom times back in the early 2000s, and then the subprime crisis came and slowed things, particularly in North America. And then the global financial crisis really caused a problem in this industry, as it did everywhere else in the world. And we had quite a prolonged period of very low sales. A scenario which I should add, you know, as I said, we're not expecting to be repeated. We don't expect this down and then L-shaped recession. We do expect a bounce back. But what came after that was, in China, this enormous stimulus, but which only lasted 2 years. And as you saw in the graph for China, you had a real boom and bust that was created there. So it does illustrate one of the issues about stimulus is you can't do it for 1 year, 2 years. It is important to spread it out. And again, as Yelena said, in the rest of the world, you know, governments were quite slow to react. The stimulus was a little too late. And then the taps got turned off a little bit too quickly when the economy was still fragile. And it really took it was a real long haul to get back to something that was like sort of significant volumes. So it is a very difficult course to plot for governments. So our outlook, short term, we're definitely looking for incremental improvements in the quarterly financials. And over the sort of the next year to 18 months, we do want to see 2021 getting progressively better, and certainly much better than Q2 2020. Medium term, I think absolutely the opportunities are in infrastructure if stimulus is done right, and I do underline the if there. It's as I said, it's not easy. It's not a criticism of governments, but it is a difficult course to plot. And I think we have to be prepared for more change in the industry. Clearly, when an industry is under pressure, there's consolidation, and that could happen. And that's something I know Carl Gustaf wants to look at a little bit in his presentation. I think there's also the potential for disruption and digitization in this industry. Again, it's a topic I know Carl Gustaf is very keen to talk about, but this is an industry which hasn't particularly gone online and hasn't particularly made a lot of use of all the data that's out there that can be generated. And if I knew the answer to what exactly that disruption and digitization would be looking like, I probably wouldn't be sitting here today. But all I will say is that this is the type of event that will spur that kind of change in the industry. So I think we have one or two questions in the Q&A box. So I will stop my screen share and try and get into that. Okay, we have one on what are my thoughts on consolidation and strategic licenses in the wake of COVID. We just saw Volvo offload UD Trucks, for instance. Thank you for that one, Eric. Yeah, if I could pick the acquirers and acquirees in consolidation, again, I probably wouldn't be sitting here. I'd be calling in from my tropical island. All I would say on that is that I think clearly it will happen. There are a lot of OEMs in this industry around the world, and there are clearly some that are under stress. You see that in the quarterly results. You see that in their profitability. I think the other point I would make is that you have companies in this industry which are pure construction equipment makers, and you have companies in this industry for whom construction equipment is an arm of a bigger conglomerate. And I tend to feel that the businesses that are kind of an arm of a conglomerate, they can, I wouldn't say be at risk of being sold off, but the dynamics are sort of slightly different between a company where all it does is construction equipment and a company which is a division within a bigger group that has the potential to fall out of favor a little bit or kind of be seen as not core with changing management right at the top. So the short answer is I don't know, and if I did know, I probably wouldn't tell you anyway. But I feel very sure that there will be consolidation in this industry, particularly now that the industry is coming back up. We've had another quick question about the market in India. The market in India is an interesting one. I think long term we see it as being very positive. Unfortunately, at the moment, the downturn which has come this year came on the back of last year, where business is always interrupted by the general election, so sales always fall. So it has unfortunately been a second consecutive year of falling sales in India, which is actually kind of quite odd against the backdrop of a government that's spending a lot of money on infrastructure, particularly in the road building sector. So we feel that the fundamentals for the Indian industry are there, and that when the country is in a position to get back to work, and obviously the lockdown is still quite strict in India, we feel things will come back quite strongly. But for the moment, I think while the pandemic is still causing problems, it is going to be a struggle. But long term, we're fairly positive. We have another question. What is the 2020 relationship between production volumes versus sales volumes? How much is production contraction versus 22% sales contraction, excluding China? I think it's an interesting point, one I didn't really have time to go into, but obviously there's been a lot of interesting fancy footwork going on with inventories really since March and April. I think what we've seen in the last 6 months is the inventory really emptying out of the system. So now that we feel the pipeline is probably as empty as it's going to get, I would expect production to start ramping up again. How that finishes up when we get to the end of the year is an interesting question. I think given that so much inventory has been shed in this process and so much stock has been shed, that you'd probably see production a bit lower than sales this year. But then, at some point, the two obviously have to catch up, and they do have to balance out. So it may mean that from a production point of view, the recovery could be very much stronger next year. I think we better call a halt there. There are one or two other questions. If we can't get them at the end, I will I will get back to the individuals who've posed them after the webinar. So now I would like to hand over to our third speaker, who's Carl Gustav Göransson, the former president of CNH Industrial's construction equipment business. He is very much a seasoned global executive, having worked in the construction equipment industry for over 25 years. And prior to his role at CNH Industrial, he held senior posts with Cargotec's Hiab brand and also with Volvo Construction Equipment. So over to you, Carl Gustav, and we'll get your slides up as well.
Thank you, Chris. A pleasure to be here, and I hope you can hear me well. I think it's been very interesting so far to listen to both yourself and to Elena, and I think very much as Elena said in the beginning, I take away a couple of her comments. I mean, it will get worse before it gets better. But I think what I would like to share, and you should be sharing my first slide now. There we go. Should be coming up. I think we do have a unique situation for the industry as we move on here. We obviously, some of us will relate back to 08, 09 when we had the crisis, but I think we have a different scenario and different ingredients as moving into this now. Back then, and we just touch upon the inventory levels, back then we more or less had a global volume of around 1 million pieces of equipment, but we also had an overcapacity in the system of about 200,000 units. So a massive inventory to take care of. I think the action has taken place of the industry, all the OEMs and all the distribution in Q2 and Q3 shows that we actually have been able to react quicker. Being slightly positive, and just referring back to what you shared with us, Chris, I think we also have an uptick in Q4 coming up. I think the rebound will be coming in Q1 as well. So there's a good demand actually compared to the pre-crisis for work out there. We mentioned markets now being positive. We have the stimulus in China. China we discussed a lot. Also to touch upon, I mean, other parts of the world is actually South America, where we actually see the good signs slowly moving. I'll take out Brazil as one market, where you can see the PMI index has actually been on historic high in September. So good news actually coming that way. Then to take another piece, the second bullet point is that the industry is up for a technical and digital disruption. We see a lot of changes here now. I mean, traditionally, we have been very product-centric in our industry, and I think we're moving away to become more of application and segment-centric in the business. If you compare to, for instance, one industry, neighboring industry that has gone through this is the ag business. The ag business has become much more field-centric, moving away from the tractor being the tractor producing something to actually to see what the farmer can do with his crops production. Chris?
Yes, I take your point there. I mean, I suppose the parallel in construction would be, you know, the difference between thinking, right, I need to buy an excavator, to the mindset being, okay, I'm being paid to dig a hole in the ground. What's the most profitable way for me to do that? Is that what you're getting at there?
Yes, correct. I mean, so it's really much more, I mean, what can we do with this application? What can it produce? And back to the old base ago, you know, the loader, the excavator, or the hauler doing something, and the performance of the machine. And I think this has actually accelerated with the COVID. I mean, forcing ourselves into thinking new offerings and new ways of working. Then I think to come back on the two other points I have here, we do, in a sense, maybe did not discuss new markets, but markets coming up. And when you did mention India, we had a very interesting question and observation on India. And maybe to add a couple of more comments on India. India is a very dynamic market. It's interesting for this industry. It has about the same population as China, 1.4 billion people. At the moment, I think it's a fourth of the size of China. So there's a lot of work going on here. In the light of this, I think we also see that with these new markets coming up and becoming probably large depending markets in terms of size in the coming 5 years, we will also see that the segments there are being arising a different way. We will most likely see what we call smart value products adapted for this special markets, products that are literally custom built for the application they operate in, and they will not have anything else than what the customer is asking for. So I think this is actually very interesting. I think to finalize here, we do see a lot of regulations and standards in our industry coming along, which we need to manage. And also this is hopefully driving us in terms of efficiency, how the machines operate, and obviously driving consolidation in business. Consolidation is still a thing I think we need to work around. And here, I think one thing we've seen starting actually last year significantly is the inroads of electrification. Electrification as such, as being the propulsion for our products, is coming faster. I think we see the time to market is faster. I think the size of equipment being able to use electrification as propulsion of sorts is actually going up in tonnage. And also the cost is coming down significantly. So this, we will see much more coming into this. At the same time, we have to manage all the diesel engine regulations. But also a point when it comes to other types of regulations we need to manage. If you think about the urbanization of our world now, we probably believe we will have in 2050 a larger part of the population living in cities. This will put focus on noise regulations, on transport regulations, and also logistic regulations. So lots of things to cope on when it comes to that moving forward.
So in the context of the construction equipment industry, are you really saying that if you stay as you are as an OEM, that's just not the best way? If you want to be part of this business in the future, then you have to change and adapt. And you've obviously prepared quite a few points to go through here on how companies might change and adapt.
Yeah, absolutely. I think so, Chris. But I think, before we go in, I think let's just take 30 seconds to reflect on our business and what we're operating in. I think according to some studies, the construction business in the world represents around 13% of the global GDP. So it's a massive business. And you mentioned it, Chris, in I think your presentation. The value of this business was around 100 billion plus US dollars, and we had a record actually in last year, a historic record here. So it's a very, very decisive big business. At the same time, if you compare this business with other things, we haven't seen as much consolidation. In the business, we have underperformed to other businesses. It's highly fragmented. The digital and technical and disruption has not come in as much as in other businesses. So it's a lot of, let's say, to end on a positive note, a lot of things to do here to move forward, I think. As it says, it's a long list. I think it's definitely the time to look into what you should do and consider not doing, and actually a choice you need to make being part of this business. But I think what many companies are doing now, and they're very much discussing the OEMs, but I think obviously the surrounding of the OEMs, the suppliers and the distribution, they're doing a significant job at these times to manage with the supply into the OEMs, but also the distributors are working very hard to manage, representing all brands to take care of the customer and following all the safety requirements in the COVID situation. But what happens now very much is that you need to manage your industrial footprint, you need to manage your cost, you need to manage your R&D spending, you need to manage your selling admin cost, and obviously redirect this given this extreme situation we have never faced before. And I think this is very much on the agenda as we speak.
So I think everyone can probably appreciate that point of we're just in a difficult situation for a year or two, and we just need to manage our way through that. Going beyond that and looking at that pyramid there, what would you pick out as the key points to take the business, ahead and forward in this new world?
Yeah, first of all, I think the learnings were done by sorting out the current situation in terms of where you place your resources. I think clearly we see the change of spending, the change of focus of R&D will stay now in what I would call basically fixing the basics. And then when I say adapt to a new business model, I think you need to change your total behavior working. We are doing this now, but it will also be accelerated by the new COVID. A couple of things just to highlight. If you take, for instance, the tech platforms, the R&D focus, you will see, and you have seen the OEMs saying that, this will be my core competence when it comes to R&D. I will focus on these areas, on these segments, on these applications for a product. Then I will partner up with different technical OEMs. We have a lot of interesting technical companies or tech platforms, new startups coming with new technology, getting introduced to our business where we see efficiency gains. And we will see a lot of collaboration with them. And clearly the products will be much more focused on what is the customer wanting in terms of information, in terms of performance. I think now with the entrance of digitization coming much more clearly, I think I want to highlight on a couple of things. we've been discussing the evolution of aftermarket business and how we can do this better. The way of taking care of equipment so far has been very much into break it, fix it mentality. Something breaks down, you fix the product, you change the part, and then you charge the customer for this, and then it's sorted. The future will be very much built on the information. It will be predictive maintenance. The transparency will be there. You will have the OEM, the distributor, the customer, the operator having a much more, let's say, close view of the of the machine, which actually will enable the all parties to have a much more active way of overseeing the equipment. And this will obviously drive the business towards that. I think also when it comes to the commercial piece and the business model, you will be seeing a more specialized way of working. The distribution will most likely think more of a product segment, a regional segment. They will focus on applications, and that the traditional way of having, let's say, a high share of mind for one product will be more in towards a share of mind into this segment, which means that they might be able to say that, to represent more brands. So I think, having said that, it's a lot of things you need to do. And to finish off, we call it get ready for the new normal, whatever is the new normal. I think you have to, given what I said, focus on what I call the must-win battles, the must-win things I clearly need to fix and focus on becoming or remaining a player in our industry. Yeah.
So I think I'd pick out 3 key themes there. You talked about new business models, tech disruption, and digitization. Another point that you kind of made and touched upon is a bit of a change of mindset from total cost of ownership. And that's quite a well understood concept, that if you want to understand how much a machine costs you, you should not just consider the purchase price, but it's the cost of maintenance, the fuel efficiency, the residual value, and so on. But you're now talking about a concept of total cost of use. Could you just elaborate a little bit on what that means and why it's important in this context?
Sure, Chris. I mean, I think the total cost of ownership has been around for a while, and it's nothing new to us in the industry. I think we made a lot of headway here in optimizing in our industry. But I think given where things are moving, given the way we view the economy today, and I would say where we're heading, this will change. And I think we've seen the entrance of new concepts of calculating a project in construction. We have tools like BIM, which I find very interesting. I'm sure many people around the call here are good experts on how to use the BIM concept, building information modeling. But having said that, I think that we're much more focused on what the customer is saying, I'm going to do this project. I will build this road. What would be all the resources I put into play, being equipment, resources, personnel, any kind of material? What is the total cost of using this? And you clearly see a trend of the less, let's say, need and use of owned equipment. I think this is a big shift, and we will see this happening. But we all in the value chain need to see this differently. So this, I think, one thing we should consider. And these, I think are among the other factors we see moving industry happening, and it's happening now. I think also to conclude, I mean, this is really exciting times for the business. A lot of things going on. I like to think that we have actually a couple of very interesting years. It will be a very challenging situation. I mean, moving into 2021, but at the same time, a lot of things happening and being a bit behind. I shouldn't say behind, but I mean, keeping up with the other industries that has basically moved faster into technologization, digitization. We see opportunities. But having said that, we need to, I think, as an industry, make sure we attract key talent, new types of people working with, data analytics, data scientists, people in any areas to actually make sure we move this business ahead in a good direction. I think that's it. So thank you.
Great. Thank you very much, Carl Gustaf. It has been pretty lively on the question and answer channel while you've been speaking, so we'll try and get to a few of these.
Sure.
First question that we had in, given the drive from government for clean energy and low emissions, how do you see OEMs coping with the cost of developing low emission vehicles?
I'll try my best to answer this one. I think, as I said, I think in the middle of the presentation, we have at the moment, I think we're dealing with, a number of diesel engine regulations at the same time. I think it's more than 3. And at the same time, we're pushing in the electrification as one of the concepts, but there's also other alternative propulsions. First of all, I think as being if you're an OEM, you need to basically decide to focus, and the cost of this is significant. And being part of, prior conference in the CEC, I think this is one of the things that basically, the associations are driving to understand that the investment that we collectively in this business need to take on. And it's also a challenge to see, how can you actually provide a good, clean environmental concept when the volume is not there? In some areas, we have it. If you see the entrance of electrification in let's say, excavators, smaller wheel loaders, handheld equipment, there is a volume that actually can take the cost. So I don't have, the $1 million answer. I'm referring to what you said, Chris. If I had the answer, it would be probably somewhere else. But I think this would be, basically for many OEMs, a choice. I put my focus here, and I probably cannot handle all the regulations. It's a fact, I have to say. Yes.
Do you think consolidation in the industry is inevitable then, in that there are so many OEMs, there's so much R&D costs, and everyone's spending a lot of money kind of researching the same thing and historically coming up with a very similar solution? Is it just inevitable that there's going to be consolidation to cut down the global R&D, or do you think it'll be slightly different and that you'll have more sort of partnership type of arrangements, more OEM supply? How do you see it panning out?
Yeah, I think it'll be a combination, Chris. Clearly, I think I hinted. I was leaning a bit towards the ag industry. You've seen more of consolidation in that business. We will have this clearly, and it's driven obviously by, let's say, the stress many of these businesses are in now as we speak, given the situation in the whole world. But this, I think, would have happened anyway. It's needed because obviously, if you think of, we can also take another business. If you take the car business has gone through this, and there's only as much market that actually can finance the spending. So you will see this. So to come back on your point, and I acknowledge your comment here, we will see consolidation. We will see more alliances. But also I think we'll see collaboration, especially on the technical side, where you see new companies, smaller companies being, partnering with the large OEMs, being a specialist in the field of expertise doing this. So a combination, but it's inevitable. But I think it will happen gradually, and it will happen by product category and focus, and it will go all the way, I think, out into the commercial piece, and to the distributor and selling equipment.
Okay, we've got time for just one or two more questions, and there have been a couple on the channel on a similar sort of theme. One asks about how you see the industry changing in markets where there's a lot of price competition, and another one along that similar theme is how will machines like electronic vehicles be introduced in these markets? India's mentioned as being a very cost-conscious market. So how do you see those sort of things planning out?
I think the first one was around pricing, right? Yeah. I think that the pricing, it's difficult to give you, a world answer. You will see, I think the pricing levels will more or less remain the same depending on the regions. You see competition is increasing. I think what I said before, the total cost of use will drive a different type of pricing behavior. You will, as I said before, you will also see a less behavior that customers are buying the equipment. It will be the total cost of use, and I think this will drive competitiveness. And you will have to look for, let's say, new revenue streams when it comes into this, and how you actually make profit in the business and actually are able to invest back into the business. So pricing, to come back on it, region-wise, will have the similar levels, but also it will in the region have experience more competition. And the second one that you have to remind me, please, was
it was about how to introduce electric vehicles in a market like that where purchase price is such a pressure.
Yeah, I think the good news, it will be having a different price tag. I don't have the exact answer. What we see, what I can pick up from my point of view is that the time to market is probably going faster. The expected price levels might be different. I think, given if we're starting, in the high volume end, We see the introduction, I think, on small equipment, especially compact equipment, mini excavators. I think you will see harmonization. It will probably have a higher price than the conventional equipment. So in existing markets, I mean, normally when it comes to new technology, you need to be, let's say, prepared to pay for new technology. Normally that is the case. But I think as it comes in at the proves reliability, you will also see a pricing being smoothing out. Coming back, I think that the other part of the question was, I mean, new markets like India. I think here they are very much looking in these markets for what I said before as smart value products, where you say these are the features I'm willing to pay for, and anything else on product I would not like. So you will probably have that type of approach to the market, saying, I need this, and the rest please leave away from the product, so to speak.
Okay, thank you very much, Carl Gustaf. We have one more question for Yelena, actually, and I think it's good to end on a big one. What impact will a Biden presidency have on US-China trade relations? What do you think will happen to tariffs on steel, of course? And this of course, is not just a global question, but one which bears quite heavily on this industry.
Okay, well, I don't want to finish this on a pessimistic note, but I think that's what will probably happen. I think the tariffs are here to stay, and that's, you know, that was our expectation before the election, and now it seems like, you know, we'll probably see a little bit more constructive dialogue between the nations, but I don't think we are reverting back to where we were before the tariffs. So that's kind of our main expectation. And I think really a lot will depend on, you know, what happens to the economic outlook next year. Certainly, I don't see any further tariffs being introduced. It would just probably kill growth in certain industries, but at the same time, I don't think we are going back. So let me just finish at that. And again, listening to the president-elect yesterday, I did not hear any concrete suggestions in terms of economic growth. Not even to say with respect to particular subjects such as taxes or tariffs or anything like that. But our view at Bloomberg Economics is that we will see a status quo on this one.
Okay, well, thank you very much for that, Yelena. I wouldn't have said pessimistic. I think status quo is probably not bad. Okay. Trying to be optimistic, trying to end on a high here. That does more or less bring things to a close for today. So a very big thank you to our speakers, Yelena and Carl Gustaf. And thank you to everyone who attended and for your questions. I'm sorry we couldn't get to them all, but if there are any specific ones on the market, I will try and get back to you on email. A very big thank you to our sponsors, Carlisle, Brake and Friction, and Faster, whose support have helped make this possible. And thank you also to our media partners, International Construction, Diesel Progress, and Diesel Progress International magazines. Here at Off Highway Research, we plan to hold more webinars in 2021. And, you know, we also hope when the situation allows to hold in-person events. So please keep an eye on the news pages of www.offhighwayresearch.com for more information. And we'll also be in contact when details are available. So once again, thank you for attending this webinar, and we hope to see you soon.